Welcome to Dorsey and Whitney's Bank Council Roundtable webinar on revised Main Street and SBA stimulus programs. I would like to introduce and hand over the presentation to Jamie Whatley, a partner in Dorsey's Finance and Restructuring Group. Jamie?
Great, it's great to have you all join us today. We have a great agenda planned for you all. We're going to discuss the latest updates to the SBA stimulus programs, what is coming and what still needs to be addressed by the SBA. We're going to discuss the Federal Reserve Board's 3 Main Street lending programs, as well as the revised terms and conditions for the previously announced programs, and also the terms and conditions for the new additional program. We're going to highlight the remaining limitations and concerns of these 3 programs. The SBA has issued updated guidance clarifying many questions that you all had on the PPP programs, as well as issued a form of forgiveness application and guidance related thereto. I'm going to turn the program over to Ken Logsdon, who's a partner in our F&R group, our Finance and Restructuring group, and he is going to update us on the SBA stimulus program.
Thank you, Jamie. So with that, what I'm going to do is I'm going to obviously focus on the SBA PPP program. We're not going to discuss the economic injury disaster loan program, though that's a component of it, but the focus here is really just a general update. As you can see on the slide here, this is a very brief, short snapshot of the PPP program, as we all are probably very familiar with. But just in short, we're talking about a non-recourse loan, no collateral. It's guaranteed by the SBA, 2-year term, a 1% interest, 6 months deferral, some very rigid application around use of proceeds. And when we'll speak in a moment here, it's certainly a forgiveness feature that is looking to become a little bit more complicated than maybe we otherwise would have originally intended. On the next slide here, this is just the high-level latest developments that we're going to talk about. The latest stimulus bill, just to remind you, it was an additional $310 billion for the PPP and $50 billion for the economic injury disaster loan program. The latest I have been able to gather as to what's remaining, my understanding is approximately $100 billion or so is still remaining to be funded under round 2 of the PPP, as it's been called. What's interesting is that doesn't include funds that have been returned. It is unclear whether the funds that have been returned are going to go back to replenish the fund, so to speak. There's some ambiguity around that, but assuming that is not the case, the latest is approximately $100 billion. So it actually, the reserve of the fund is being depleted at a slower rate than the first round, but it's, relatively speaking, still being used quite aggressively, certainly more aggressively than what was originally intended. As for new guidance, the first item we're going to discuss is the latest of the repayment program. There's a safe harbor feature that got a great deal of attention and still remains applicable because it's going to speak to issues in connection with loan forgiveness. Then we'll talk about the loan forgiveness and then other related updates, the HEROES Act, recent rules, FAQs, and other legislative action. But with respect to the new guidance around the safe harbor, I think most of the audience has been paying a close attention to this particular item because it really does focus on the necessity or needs-based certification under the PPP application. If you recall, there's a certification that a borrower makes that due to economic uncertainty, the loan request is necessary for ongoing operations. That created a great deal of uncertainty, but on the outset, most were comfortable that was a relatively low bar until an FAQ was published, FAQ 31, by the SBA, raising the bar significantly for, quote, large companies and requiring those, including publicly traded companies, to look to, quote, other sources of capital that don't have terms that would be deemed to be significantly detrimental. And that created a great deal of consternation industry-wide. And that came to what we now have as FAQs 46 and 47 that was published May 13th. to really address the ambiguities and concerns the business community had around this uncertainty. And it ended up creating a safe harbor in respect of dollar amounts. Essentially, loans, PPP loans, when aggregated with affiliates under $2 million, are going to be deemed to be loans that were needed, and that certification will be deemed to be made in good faith. Loans above that amount will be subject to a standard review, and we'll talk a bit about more of the qualified review with respect to those loans in just a minute, but they do not get the benefit of the safe harbor. Importantly, the $2 million threshold picks up PPP borrower and its affiliates. So if you aggregate the loans to applicant and all of its affiliates and it's over $2 million, then presumably it's going to look like all of those applications are going to be audited, but that still is yet to be determined exactly how that looks. Importantly, this safe harbor only applies to the needs-based certification, and it doesn't cure any other deficiencies, and I think that's important to keep in mind. You know, we kind of have two safe harbors going here now. Up to this point of publishing of FAQ 46 by the SBA on May 13th, the safe harbor was the repayment safe harbor, where companies that were unsure whether they would be able to satisfy this needs-based certification could just send the money back by a certain date. Under FAQ 47, that date was pushed to May 18th, and that has now come and gone because that was yesterday. But if you had a loan over $2 million and you were unclear or uncertain whether the SBA would take a closer look and determine that the needs-based certification wasn't satisfied, then you could actually repay the money in full, and you wouldn't be criticized in that respect. But again, it's not going to cure other deficiencies, so that's an important item to keep in mind. As for the repayment activity, some would say the safe harbor was really directed at publicly traded companies, but interesting fact, only just over 60 of the publicly traded companies that have participated in the program have actually repaid the loan. There's approximately just under 350 of the publicly traded companies that have not repaid the loan. So there is a material portion of the publicly traded business community that participated in the program that believes that they had a very reasonable and strong case for having access to the PPP. So that'll be interesting on the back end to see how that looks. As for auditing, again, 2 million over will be audited, 2 million under may be audited. And when it comes to the auditing and the criteria that the SBA will be looking to, there's this new concept that was raised under the FAQ 46 of an adequate basis for the required certification. The SBA made it clear that they are going to see, with respect to loans being audited, clearly loans over $2 million. It remains unclear whether that's going to apply to loans under $2 million that happen to be audited. For internal consistency, I would assume that the good faith certification will be deemed to be provided and imputed to those types of loans, but that is one of those questions. But certainly loans over $2 million, the SBA will be looking to see if the company lacked an adequate basis for the required certification, and if they determine that the company did, then they will likely require the loan to be repaid. Timing is uncertain, I presume promptly. Is there an appeals process? That is unclear. And a more interesting ambiguity that has arisen here is, what else would the SBA be looking to? Does this mean False Claims Act by the SBA is off the table, even in respect of loans over $2 million? I think it's unclear. Some believe that that's in fact what this does mean, but I think if you have a flagrant situation where a company clearly ran afoul of the False Claims Act, I'm not so sure the SBA would simply rely on this new adequate basis standard, but time will tell. And also with respect to significantly detrimental capital, you know, if company has capital that isn't significantly detrimental, is that standard still applicable? We don't know. Again, that came out of FAQ 31. The FAQ 46 also went on to speak to that it will not pursue administrative enforcement or referrals to other agencies based on this needs certification alone. But that still is no guarantee that there won't be other government agencies looking at it. In fact, it has already happened. The Department of Justice has been using its subpoena power to reach out to lenders. The SEC has been reaching out to publicly traded companies, ostensibly to see whether the needs-based certification was satisfied. So that is developing, and we'll be tracking that very closely. Also, under the False Claims Act, there's what is known as QTAM or QTAM or QUITAM. There's several pronunciations, but however you prefer to say it, it's a private action against a company, and they look to the False Claims Act and the standards therein to claim that a company has run afoul of the False Claims Act. And that can be brought by a private citizen. It doesn't need to be brought by the SBA. So that remains a lingering risk. But importantly for the lending community, notwithstanding all of what we've discussed here under the repayment safe harbor and these audit requirements, unless there's standards that have been implemented, this is not going to affect the loan guarantee by the SBA. Next slide, please. Let's go ahead now and jump into the most recent development, and this speaks to forgiveness. The forgiveness application was published last Friday, and there's quite a bit contained therein. And my next two slides will speak to the substance of the forgiveness application. I'm probably not going to touch upon all of the materials in these two slides. There's much to be discussed in these slides. So just look to this as kind of a general breakdown. But let's go ahead and talk about some of the highlights. I do like that the application addressed some of the ambiguity that was out there, but then of course it has opened up some other questions. One right off the top is that at the top of the application, it says that the form expires October 31, 2020. That's all that's stated. And so it's very unclear if that's the intent, that would be, in a sense, the cutoff date by which a company could ask for forgiveness. It has been, asked often, when does a company need to apply for forgiveness? There's much talk about when a lender must respond to an application. They must respond within 60 days. And if they determine that the company is eligible, they send it to the SBA, and the SBA has 90 days to reimburse the lender. But there's still some ambiguity around the front-end process of when this happens. So that creates another area of ambiguity, or at least that ambiguity remains. The 75%, 25% rule also remains applicable. 75% of the amount to be forgiven can't be, or no less than 75% can be attributed to payroll costs. Covered period is the 8-week period from when the loan is funded, but there's also an alternative payroll covered period, which is the 8-week period starting on the first day of the pay period immediately following loan disbursement. I believe that's a nice feature to help companies to deal with the complexity that would inevitably arise if they're required to track their expenses mid-period. The paid and incurred ambiguity has finally been addressed, and that was nice to see. They do allow for items that have been incurred to be included, provided they're paid before the next regular payroll date after the covered period ends. So that's helpful to bear in mind. With respect to the FTE reduction, here they gave a little bit more color. They speak to the average FTE being divided by 40 hours. The IRS has adhered to a 30-hour standard traditionally. And even the SBA in the past, under the Affordable Care Act, had to look to some kind of hourly standard for purposes of determining what companies needed to adhere to that act. And they adopted the IRS standard. But here they deviated. But perhaps maybe the trade could be in this other method that's been provided, whereby a company can give a value of 1 for employees over 40 hours and a value of 0.5 for employees that have worked fewer than 40 hours. So perhaps that could be beneficial in some cases. And then there's also not going to be a penalty for not having a full-time employee due to an employee not returning following a good faith written offer to rehire. And also cases where an employee has been fired for cause, they voluntarily resigned or voluntarily requested and received a reduction of their hours. So that's an important and unique feature that we are seeing for the first time here. And then, of course, we have the safe harbor for purposes of calculating the FTE reduction here, the periods that must be compared, and that is February 15th to April 26th of 2020. the full-time employee numbers should be restored by no later than June 30, 2020. Following on the next slide, continuing on the next slide, we have this new salary hourly reduction calculation. In the Act, it just spoke to salary, but we'll see in the application there's now an hourly component, which I think makes perfect sense. And so that now has been added to the mix. The math is, I think, relatively straightforward. But again, as we have been tracking this, there's a reduction by more than 25% of the salary or hourlies of the average annual salary, if it's a salary situation, for the applicable period, and hourly it will be done by a weekly average. Then that dollar amount will count against the company, and there is going to be a safe harbor if they restore that by June 30. Now, for supporting documentation, the list looks very similar to the list that's already in the Act. What was important here is they added this notion that the documentation that must be maintained until no earlier than 6 years after the date the loan is forgiven. So clearly they need the companies to hold on to these documents for purposes of auditing for who knows how long, but that doesn't look quite different from the requirement under the IRS. And then as for certification and reliance by the lenders, again, lenders can rely on borrower documentation for loan forgiveness. The SBA said that this is necessary and appropriate. Does it cover clear error? Perhaps it doesn't. And importantly, we're starting to get some reports, again, of the Department of Justice looking to lenders and banks that have participated in this program, using the subpoena power. And all that's really been spoken to on that to date is that those powers aren't being directed at lenders specifically per se, leaving open this opportunity, of course, and they must, that lenders may be looked at closely. It seems very difficult to contemplate situations where if there's clear, willful ignoring of facts, or even aiding perhaps a borrower that was unqualified to begin with to participate in the program, how that's going to be viewed. So though the front end of the program was implemented relatively quickly, money flowed very fast, as we found, and lenders across the country, thousands of them participated in this vigorously. The loan application process is going to be or forgiveness application process is going to be far more complicated. There's going to be a lot more involved, and just the application itself is far more complicated than the original application for the loan. So we expect this to be really the quagmire when it comes to the program. All the lenders that have participated in this program were able to process things relatively quickly up front, but it's going to probably be a completely different endeavor on the back end. And so we're tracking that closely and looking for ways that we can be of assistance in that regard on the legal front, because we expect there to be a great deal of effort put into doing that properly. And I think it's going to require many lenders and banks across the country to take a very close look at their processes to make sure that they have all their ducks in a row, so to speak. Now let's go ahead and go to the next slide. This is just a brief summary of the latest developments. Here we have the HEROES Act that's currently being discussed by the Senate. This contains a repeal of the 75% rule, perhaps extending the program to December 31. Down below, I make mention of other legislative action, one form of which is the Paycheck Protection Program Flexibility Act. That has other features, such as allowing the forgiveness period to go beyond 8 weeks, originally floated to be 16 weeks. I think the latest I've heard is mention of 24 weeks, so it's unclear how that'll look and the complexities that will arise when they do that. The eliminating of the non-payroll expense, 25%, 75% requirement, eliminating the restrictions around the 2-year term limit, for example, the rehiring deadline being pushed out, so on and so forth. So even on the forgiveness front, there's much that is in flux here. And we still continue to see FAQs. Just in this last week alone, we saw one addressing partnership compensation, changes to seasonal employers, and eligibility of electronic cooperatives, electric, not electronic, electric utility cooperatives. and 500 employees or less do pick up foreign affiliates. And even that has a safe harbor baked into it because there was some great deal of confusion there. So with that, I'll turn it back over to Jamie.
Great, thanks, Ken. We will now turn the presentation over to Joe Lynyak, who's a partner in our financial service practice group, and he will summarize the Main Street lending programs.
Well, good afternoon, everybody. I hope everyone listening is healthy and safe, including your families. My piece of this is going to be the amendments made to the Main Street lending program. And as you may know, in March, the Federal Reserve Board announced the creation of several credit facilities under their Federal Reserve Act Section 13(3) authority. And that goes back about 100 years to the creation of the Federal Reserve Board, where they're able to take action to protect the economy. In the last meltdown, there was criticism about the fact that they were giving out money supposedly to help friends and not assist others, and the Congress changed it so that they have got to only submit assistance to companies that will help the economy and can play favorites. And that's probably the motivating factor for all of the numerous facilities that they identified, so that they're all put in place and ultimately will be funded. On April 9th, the Federal Reserve Board announced two credit facilities which were of real interest to small and medium-sized companies, and they called them the Main Street credit facilities. There's two of them, the Main Street New Credit Facility, which we're going to refer to as the New Facility, and the Main Street Expanded Facility, which we're going to refer to as the Expanded Facility. And they were capitalized by the Treasury sending over $75 billion to the Federal Reserve in order to capitalize a special purpose vehicle, allowing a total amount of lending in the amount of $600 billion to be made. The special purpose vehicle would purchase 95% interest in these two facility loans, capitalization of about 2.5% or roughly bank capital. And the terms and conditions were outlined in 4 exquisitely written pages, two per facility. And when I say rough outline form, I really mean rough outline form. On April 30th, thankfully they clarified the programs, and they added a new one, the Main Street Priority Program, which we're going to refer to as, guess what, the Priority Program. They really began to put some meat on the bone. We submitted some detailed recommendations to the Treasury as well as to the Federal Reserve Board, and happily they accepted about 80% of our recommendations, some of which we're going to be focusing in on, and many of which were incorporated into these changes which they have made. I will note that in the remainder of my presentation, it may be somewhat dense in nature, but it's because of the fact that they're now putting in place the terms and conditions necessary to actually operate these programs. And I think that the important point for the audience here is to think as we're going through them, does this all make sense? Do we need more information? And Erik, following me, is going to talk about the remaining issues that are out there and things that need to still be clarified. Next slide, please. Well, what they did on April 30th is they clarified the new Main Street new loan facility. And by the way, when you take a look at these summary documents, they use a number of dates which don't necessarily line up very well with each other. So you have to be really careful as to what they mean, whether it's the date they were issued, whether the date they're effective or whatever. But the SPV is going to be operated by the Federal Reserve Bank of Boston. The SPV will purchase a 95% interest in so-called eligible loans, and the lender must retain a 5% interest in the loans that are sold or participated over to the SPV. And this harkens back to the concept of having skin in the game. Let's talk a little bit about eligible lenders and eligible borrowers. they expanded the definition of eligible lender. Now it's a U.S. FDIC-insured depository institution, which is a bank, savings and loan, or credit union. What they did is they expanded it to include a U.S. branch or agency of a foreign banking organization, or FBO, many of which are located on the East Coast and the West Coast. But foreign banks supply a very high percentage of loans made in the United States, particularly commercial loans. And so this inclusion is certainly appropriate. Who else is an eligible lender? Well, U.S. bank holding companies, U.S. savings and loan holding companies. In the case of foreign banking organizations, and depending upon their size and how they're comprised, they may have to have a U.S. intermediate holding company, and that would qualify any subsidiaries of any of these categories. And that also means that most U.S. affiliates will also qualify. In terms of eligible borrowers, things have changed a little bit here. We've now upped the definition of a eligible business to a business with 15,000 employees or less, or the business earns up to $5 billion in 2019 annual revenues. Operational requirements, it has to have been organized prior to March 13th of this year. It cannot be a so-called ineligible borrower, and this is really getting into the arcane issues going back to SBA regulations, and you've got to go do a deep dive to see what an ineligible borrower is. And there's a number of exceptions to what the ineligible borrower criteria are. For example, many charitable organizations are going to be eligible borrowers even though they're on the list of ineligible borrowers. Mostly lenders are not going to be qualified. There's a small exception for certain types of mortgage lenders and mortgage servicers. So again, a deep dive is certainly required to take a look at this. Now, one of the really strange things, which I think Erik is going to talk about, is if you're an eligible borrower and you have a loan with an eligible lender, the loans must have a pass classification. And that's kind of making people scratch their heads, and we're going to have to look at that more closely. The business must be created or organized in the United States and have significant operations and a majority of its employees in the United States. And then finally, a number of things which are pretty self-evident, I think, in that you can't dip your toe in the water for both the priority loan facility, the extended loan facility, or if you're a larger lender, the Federal Reserve Board's primary market corporate credit facility, or if you receive funds as an airline or as a national security company, likewise, that disqualifies you. Now, the loan terms for the new facility, it has to be originated after April 24th. And again, my reference a moment ago to the fact that these dates have got to be aligned. It's a 4-year maturity loan with amortization of principal and interest deferred for 1 year. But they did indicate now that interest can be capitalized, and that means compounded. So for any of you loan aficionados that are in a particular state which requires you to say that interest must be added into principal in order to compound it, you got to pay attention to that. Repayment is a little bit different. 1/3 must be amortized at the end of the second year, and it says amortized, but it's unclear whether or not it's amortized or whether or not it's got to be, there's a bullet due at the end of the second year. 1/3 due at the end of the third year, and 1/3 at loan maturity. And again, unclear whether or not this is amortization or whether or not these are balloon payments. One of the things which they did, which was very, very helpful, was that they backed off the use of SOFR, which is the secured overnight financing rate that the Federal Reserve Board is in love with, and they went back to LIBOR plus 300 basis points. I would note the fact that there's been criticism that by making it LIBOR and 300 basis points, some borrowers have said this is not a very attractive loan, this is above market loan. We'll see what happens on that. Minimum loan size is now $500,000. Maximum loan size is $25 million or 4 times borrower's EBITDA, and Erik is going to talk about the EBITDA issue and how complicated it can be. Now, again, another thing to focus on that's a little bit different is that the loan cannot contractually be subordinated to any existing debt of an eligible borrower. Erik is going to talk about that, but that is now a requirement, and you can prepay without penalty. Next, please. Now let's go on to the new guy, the priority loan facility. This is a little bit different in that instead of the Federal Reserve purchasing 85% of the interest in the loans, they're going to be, 95%, they would be purchasing 85%, which means that 15% would be held by the originating lender. The same definitions apply as to eligible lender and eligible borrower, and likewise, they can't participate in a new loan facility, the extended loan facility, primary market credit corporate facility, or the airline or national security direct payment scheme under Title IV of the CARES Act. What are the loan terms? Well, the loan terms, a loan originated after April 24th with 4-year maturity. Interest can be capitalized and compounded. And here the repayment is a little bit different. 15% at the end of the second year, 15% at the end of the third year, but a bullet payment of 70% at loan maturity at the end of the fourth year. LIBOR, again, is 300 basis points. Minimum loan size is $500,000 and $25 million, or the lesser of $25 million, or 6 times the borrower's 2019 EBITDA, which means that this is going to be a more highly leveraged company. And whether or not, what that does mean, though, is that there's probably going to be more risk involved, and they're asking the lender to take on more risk because they will be holding not 5%, but 15% of the interest in the loan. Now, here, in terms of security and loan priority, here's where it changes from the new loan facility. The loan must be senior in priority and security, or pari passu to existing debt of an eligible borrower. And Erik's going to talk about that. Prepayment may be permitted without penalty. And then finally, the squirreliest of all of the facilities, the extended loan facility, we go back to 95% purchased by an SPV of an interest in the loan. The eligible lender and eligible borrower are the same as the other two programs. Again, they may not participate in the other two loan facilities, the new loan facility or the priority loan facility or the Fed's primary market corporate credit facility, or receive assistance under the special provisions of Title IV dealing with airlines or national security companies. When I said this provision this loan facility is a little squirrely, well, it was squirrely before and it stays that way. And that's because this facility indicates that there must be an existing facility where the loan was extended before April 24th with a remaining term of at least 18 months, and there's a new advance on top of the old advance, which they call an upsized tranche, which must be originated on or before April 24th. Now, I know that you're all sitting back saying, well, we're going to be going through these loan terms. Are they the same loan terms as what came before? The answer is not necessarily, and probably not. And how do you go about doing this? Makes it a little complicated. But anyway, the new loan terms for the upsized tranche, 4-year maturity, interest can be compounded, deferral for 1 year, repayment, similar to the priority loan facility, 15% amortized at the end of the second year, 15% at the end of the third year, and a 70% bullet at the end of the fourth year. LIBOR, again, 300 basis points. Now, minimum loan size here is higher. It's now up to $10 million, and the maximum loan size equal to the lesser of 3 computations, $200 million, or 35% of the borrower's existing outstanding and committed but undrawn bank debt, or 6 times the borrower's 2019 EBITDA. And so that's going to be, again, a computational problem which we're going to have to address The loan must be senior in priority and security or pari passu to existing debt. So it's similar to the priority, but different from the new loan facility. And so that's something which we're going to have to, again, address. Next slide. Okay, now in terms of loan origination and administration. Well, 75 basis points for a extended loan facility loan as a fee paid to the SPV, 100 basis points for the new loan facility or the priority loan facility. However, you can pass this on to the borrower. And I guess what people are going to do. In terms of the loan origination fee paid to the lender, 100 basis points can be paid for the new loan facility or the priority loan facility, but 75 basis points, a lower amount for the extended loan facility. Servicing fees, the SPV will pay the lender 25 basis points per annum for the principal amount of its participation for loan servicing, and the SPV will cease purchasing loans on September 30th, 2020. I will just digress for a moment and ask the question whether or not that date is going to have to be extended, because that's quickly approaching and very little has been put in place in what is really becoming a pretty complicated loan program to start up. Next slide. Well, they changed the concept of attestations to now certifications and covenants, which is really nomenclature that we're a little bit more used to. And they've separated them between that of a lender and that of a borrower. An eligible lender must do a couple of things. One, they're not going to require, it cannot require that the loan proceeds from any of these programs be used to repay or refinance pre-existing loans or lines of credit made by the lender to the eligible borrower. But here's an important exception. If the existing credit is due or is in default, or is about due and will be in default, those payments can be made. So in other words, you can't just grab the money and pay off an existing line of credit. If they're due and owing, you can use this for purposes of making those loan facilities current. The eligible lender cannot cancel any or reduce any existing lines of credit, again, except in the event of a default. And arguably, it also means that they can't do that in terms of pre-existing portions of the extended loan facility loan. Now, what Erik is going to talk about is there any such thing as a standard methodology for calculating EBITDA, but an eligible lender is going to have to use whatever their standard form is for purposes of making that calculation. And the eligible lender will have to also certify that it qualifies to participate in the Main Street programs, probably by filling out a form and submitting it to the Federal Reserve, which does not seem to be a very complicated action. Now, what about the borrowers? Well, this lines up pretty well with what we spoke about in terms of the in terms of an eligible lender, in that they'll refrain from repaying existing debt unless it's mandatory and due. So you've got the existing debt, you use this debt to pay for operating and operations, and as I've mentioned, this really has got many of the attributes of being an operating capital loan, which makes sense in terms of doing this. You can only repay existing debt if you have to. You can't voluntarily cancel or reduce debt, again, unless it's due and owing. Now, a new factor, you have to demonstrate a reasonable belief that you can meet your financial obligations for 90 days, and that means that you do not expect to file for bankruptcy. Kind of a tough evaluation, which is going to have to be done. You're going to follow the compensation, stock repurchase, and capital distribution restrictions that are in the CARES Act. A question that you're all asking is who makes those determinations in terms of certain things such as shares being taken back and so forth. Unclear what's going to be happening there. There is an exception, though, if you've got the type of structure such as a limited liability corporation or partnership where money has to be distributed to pay certain tax obligations, you will be able to do that. And you also have to certify that you qualify to participate in the facility, which again does not seem to be particularly difficult. So these are relatively dense terms and conditions. They're getting better. As Ken probably mentioned a while back, they are constantly changing the FAQs. There's an FAQ now for the Main Street programs. We've incorporated many of the provisions into this presentation, but you simply have to check every day to see whether or not they supplement it, whether or not they change it or expand on it. And now I will turn the program over to Jamie.
Great. Thanks so much, Joe. We'll let Erik now talk, who is a partner in our F&R group, our finance and restructuring group, and he will update us on program concerns relating to the Main Street lending program.
Hey, thanks, Jamie, and thank you, Joe, for that summary. Little update before I kind of jump into the information on this this slide. I watched, you know, as I generally do on the weekdays, I watched C-SPAN this morning. The Senate testimony of Chairman Powell and Secretary Mnuchin giving a quarterly report on kind of the status of these various CARES Act facilities, and then in particular the Main Street facility. I think two big takeaways from that. You might see this in the news if you see that. I think the timing for when applications are going to launch here, it looks like the end of May. And I think Mnuchin looked at his calendar and realized that's a Friday and said, well, or the first couple of days of June. So probably first couple of days of June, applications will be open. You don't know what the applications yet will look like. And then the second item, and I think this is just a theme that was repeated many times in the testimony, I think, but in both from Chairman Powell and Mnuchin, but both the Fed and the Treasury, I'd say, are committed to seeing participation here. So, you know, when this opens up, if demand is sluggish, I think I would expect further changes, further clarification, maybe industry-specific programming here. So keep an eye on, to Joe's point, keep an eye on the Fed's website. I would also expect some sort of guidance or additional clarification between now and when the applications go live. So I think the last time we spoke was on the 29th. We gave a presentation, and a matter of hours later, the Fed had updated its website. So maybe we'll get lucky and it'll be tomorrow morning again too. I think in general, if we had to kind of say what's taking the temperature of the market, what we're seeing is not really yet a rush of demand for these programs. We're getting a lot of questions, both from the lender community and the borrower community, about very specific fact patterns. And I think we've seen specific industries and borrowers with very specific debt structures for whom this is a clear winner. But I think as of yet, there's probably, just because of the lack of clarity on a few of these things, we're still not seeing the rush that we did, for instance, on PPP. Now, granted, this isn't free money, so that might explain some of it. So this slide in front of you, so this is, you know, going to just bullet point quick what Joe already kind of touched on, but this highlights again, I think the Fed really signaled on April 30th when these were published, and again today at the Senate hearing, that it will work to expand the Main Street lending program if market participants continue to signal a general lack of enthusiasm. I guess these are just a few highlights again that Joe mentioned, you know, with the dollar threshold and for revenue, and the number of employees went up to bring in larger borrowers. The minimum size of the loan went down to bring in smaller borrowers, right? Joe mentioned that, hey, instead of just a straight EBITDA calculation, the term sheets are now allowing for a more borrower-friendly adjusted EBITDA. There is certainly some complexity there, though. If it's an easy case, if you're basing the documents on an existing loan agreement, you can borrow your EBITDA definition right from there. But if it's a new transaction with a new lender, there's a bit more thinking to be done about what sort of a similarly situated borrower would have for EBITDA adjustments. A little bit lack of guidance there, but probably not the most complex issue on this presentation. I'd also say, you know, as if on the borrower side or for the lender folks listening, and if you're penciling in the leverage calculation, I would pay attention to, there's a bit of nuance in the calculation of debt because it's, you know, undrawn but committed debt, and kind of pay attention to what we're seeing a lot of communication from presentations and white papers about complexities in the debt calculation piece on the leverage calculation. So worth kind of double checking. Another one to really, so I mentioned this, there's a refinancing option that's now built in, and I think there's this goes too with all the priority scheme, and I'll touch on this in a second, that Joe hit on, but this is another place to really slow down and work through each of the three options and the related FAQs slowly to ensure that that you're picking up on the nuances between each of the programs. We saw, and this is both for the borrowers and for the lenders, that the scope of attestations and certifications was narrowed. I think so. That was a positive, something we had flagged as a concern, and others. In addition, Joe mentioned foreign banks are eligible now. We're still, though, seeing private funds remain ineligible. That was something specifically addressed by at the hearing today, that one of the senators pressed on, hey, why are you limiting this? And I think it was again expressed, as it's expressed in the FAQs, that this is something that the Fed is keeping an eye on, as opening up the possibility of having non-bank lenders become eligible lenders. On the operational side, Joe mentioned, I believe, but the SOFR requirement that had appeared somewhat surprisingly in the initial term sheets is replaced with a standard LIBOR definition. There is some gloss about LIBOR replacement, since these loans will presumably be in effect longer than the duration, the continued duration of LIBOR publication. Guidance on the ARC language being used for LIBOR replacements. That's one situation where they have given clear guidance on what the documentation should look like here. But so with these program improvements, I guess I just want to spend the next couple of minutes touching on some of the concerns, again, the kind of the negative side that we've identified for borrowers and lenders, and there may be some opportunities in here for you as well. But so this is a new piece, the SBA piece. So to be eligible, Joe mentioned, a borrower cannot have more than 15,000 employees or annual revenue of more than 5 billion. It's either or, so that's a positive. But the concept of how do you determine, how do you count revenue, how do you count people, the idea of following SBA guidance on affiliation is new. And I think in particular, commentaries suggesting this is targeted at private equity specifically, where multiple portfolio companies will exist under an umbrella of common control, something to think about maybe in the family office or another similar structure there, where aggregation needs to be considered for both on either the employee or the revenue side. This next bullet, this one is not a new requirement, but I think touching on a little bit of what Ken had mentioned, I think there's some more attention being paid to CARES Act related restrictions. I think as folks became a little bit more familiar with the certifications under the PPP. So that certification requirement actually derives out of this is the certification that essentially that adequate credit accommodations are not available to the borrower here, and therefore this program is a necessity. The exact verbiage of what the certification will be here under the Main Street program, I think folks are predicting it will be softer. There's actually a bit of confusion where that language had appeared in the initial term sheet. It was removed in the April 30 iteration of the term sheets, but we still do expect there to be some finding of a lack of adequate credit accommodations is going to be necessary. So on the borrower side, again, if you're thinking this through, start to diligence that and document that when we expect, inevitably the certification will be required. Another observation on the CARES Act, you've got the restrictions on distributions and share buybacks that continue for actually for a year after the Main Street loan is repaid. Something that's arisen as kind of a point of concern is just what's the, while the loan is outstanding, sure, the remedy for this kind of a breach is straightforward, right? They can default, call a default, accelerate the loan, collect default interest perhaps, but we really don't have a clear idea as to how this will be enforced in that tail period, whether the lender has any role in monitoring, presumably not, but certainly the borrower may be subject to penalties or fines for breaches of something like executive comp in the year following payoff. I think, so with respect to solvency, the bit of background, so this is the sound financial condition bullet, the bit of background, so the Fed is prohibited from financing, zombie companies, is a term of art. The term sheets and the FAQs that were published get at this issue two different ways. Joe mentioned the certification that you don't expect to file for bankruptcy and that you can pay your debts in the next 90 days. This really is not a typical solvency rep. And so I think this is another one to slow down here with counsel to consider, certainly if there's something in motion for a bankruptcy filing or discussions with counsel regarding the scope or the nature of a bankruptcy filing, I would be very, very cautious here taking and making that certification. This pass rating is a bit more interesting. I think, in general, the borrower does not know, and it actually, we can dig into this if it becomes relevant for you all, but may not be able to know. It may be confidential information where a borrower sits in the lender's risk rating system. I guess just would caution you before communicating that information to the borrower in the underwriting process. You should discuss with, so on the lender side, you should discuss kind of with your compliance team or reach out to Lynyak whether that information is proprietary or confidential. Yeah, I mean, so the next couple bullets really aren't new. Again, I think just remain impediments to doing these deals. Joe touched on the complexities of the priority scheme in the three different loan options. I think you're going to need to get existing lenders on board under both the extended and the new scheme and the priority scheme. But I think the key is in certain iterations of a cap table or your debt profile, something like a split collateral deal where you have a revolving lender maybe on an ABL or just an ABL loan generally. Some structures just simply are not going to work to have an additional layer of shared collateral put on top. And so certainly if you're contemplating doing one of these loans, either from the lender or borrower side, something to think of in advance. There is a note in the FAQs indicating that that ABL or asset-based borrowers specifically are kind of under consideration for additional accommodations here. But I think just an observation that, if you're trying to obtain consents to either, a senior or a shared collateral structure, that's going to be very challenging. Nothing new there in particular, but the different permutations of the programs didn't make that easier, I'd say. I think let's jump to the next slide and just kind of think about this from the lender's perspective. The good thing that we observed, touched on this, significantly more narrow lender certifications. I think a couple places to consider what one of the FAQs indicated as the lender is kind of monitoring and servicing one of these loans. To the extent there is a breach or evidence of fraud or misrepresentation, there's a reporting obligation. And this now gets back into something we talked about last month and something alluded to here is kind of the mechanics for servicing these loans. if a lender has just a 5% or 15%, depending on the hold in the program, interest, generally that kind of minority or extreme minority position gives you no control. But then theoretically this lender with a 5% interest is going to be managing the credit on behalf of the SPV. We don't really have a clear picture as to what that process is actually like, other than to say, if you discover a breach, you have to report it. So what if you can waive a breach? We don't, so that I think is just at a program level, because that's going to be across all of these options, something that lenders will need to consider of whether you want to walk into that, that kind of complexity and uncertainty. Zooming in at the specific borrower level or at the deal level, the lender, it's clear in the guidance that the lender needs to make an underwriting determination. And presumably there's some sort of exposure to the Fed if the underwriting is inadequate. And I guess the complexity here is, and I'm experiencing this with some of the lender clients we interact with, but how do you underwrite in an environment where you know, many companies are acknowledging that past performance is not an indication of future performance. You know, it's just, and then consider the tension, right? So you have, on the one hand, there's the need for the borrower to certify that there's a lack of credit accommodation on the one hand, but then here there's this dynamic that the lender has to conduct its own favorable underwriting. And so I think this, that's a tension that's going to need to be resolved. A couple of these other points, I think, speak to some of the intercreditor complexities. Some of the restrictions on assignment that Joe mentioned are just going to be perhaps deal breakers, certainly from an underwriting perspective. I would consider those to be material pieces in the underwriting analysis, and maybe too big of a hill to climb. Let's jump to the next slide. I think just to round this out, thinking through, mention that we don't really know what the application is going to look like, either for borrowers applying for loans or for registration of lenders. We're hoping we know soon. We talked back in April, and I think this again remains true. The documentation here is going to be pretty complex, and there's not a lot of guidance here. So whole new loan documents for the new and priority loans. We don't have a form provided by the Fed, and that's probably on purpose. And then the extended loans, you have your underlying loan documents, but to shoehorn this set of terms into the existing loan documents, there is going to require some complex amendments. And I think I make the note here about loan software. You know, if you think about a deal where a true bilateral deal where there's just one borrower and one bank, and it may be booked on a single bank loan software system where suddenly if there's a participation interest in the servicing component and a second facility built in on the extended loan, for instance, the software, it may require migration to a different booking system. Just a complexity that lenders are needing to consider, and getting to, you know, kind of considering what can you do today if you're on the lender side. I know a lot of our clients are already, we've had discussions with a number of clients. A lot of folks are looking into kind of some of these logistical things. If you're a borrower, well, I guess on the one side, if you're just trying to stay informed on this issue as a matter of interest or getting your CLEs, you know, fine. Keep an eye on our coronavirus digest. You know, we're going to be providing updates as they come out. But if you're any way a decision maker at a borrower or a potential lender, you really should get on the Fed's website, check it regularly, get your hands on these term sheets. This is a little mind numbing, but it's actually pretty accessible. It's still a limited volume of reading, 3 term sheets and a dozen pages of FAQs. It's something that you can come to understand to a conversational level with an afternoon or evening of reading. Maybe just Jamie, invite you back on. What are you, in the last 30 seconds here, what are you seeing or advising clients, and maybe as a send off or any other takeaways on what you suggest folks should be doing?
Well, if you're on the lender side, obviously with the borrower, you know, at this point running out of PPP funds, I think you can expect a lot of interest. So if you're an eligible lender, I would start kind of marketing the program, determining which borrowers would find the programs useful, and which programs you should steer them to. Obviously, if you're on the borrower side, you know, you need to look at eligibility and again, which programs would be beneficial, and start working with your existing financing transactions to see what consents would be needed to start that process so you're ready to go when it kicks off.
I think that makes sense, and I think that's a good one to leave folks with. I don't know if you had any other observations, or if Joe, Lynyak, you thought there was some other pearls of wisdom to rain down on us.
I think we've ended up at the witching hour.
I agree.
Well, great. Thank you all so much for joining us. And if you have any other questions or follow-ups, we welcome you to reach out to the presenters or call on your trusted Dorsey contact. Thanks again so much.